All right, welcome everybody to CRInvestor and TheChasm's Joe Power Options Show. This is episode 2 or 3, I think we're up to now on YouTube. Lots of fun. This is a show where Joe and I we both like to look at and trade options. We look at various option strategies that look interesting and potentially profitable from the long side of the calls and the short side of the puts perspective. I happen to run this website that you're looking at right at the moment called the Canadian Rational Investor, therationalinvestor.ca. You may hear little bloops and blurps through the presentation. Basically, I have people constantly asking to join these, so you can join and watch on YouTube, or if you're fortunate enough to be on the tradingview.com website, you can come and join the Google Hangout and be part of the conversation. Like I just sent out to another person here just a moment ago. So hello, Joe. How are you doing today?
Doing pretty good.
Good, good. We just so happen to have, well, I guess we can leave it on the on my website here, and you can see in the Twitter feed that the announcement has gone out to the world, and we have people slowly trickling in. Here's Eric. Hello, Eric. I don't know whether you can audio with us or not, but anyway, he's in the Google Hangout group. So if you do want to post questions to us there, feel free. Anything exciting happen over the past week for you in options land, Joe?
Um, I still got that. I wrote my first call option, so that's exciting for me.
Oh, good. That's on the plug power, eh?
Plug power, yeah. Market's seen a rough 3 days though, so I'm sitting. I'm sitting at about break even because I got the premium on that call, but plugs dropped about $1.
All right, let's see if we can find plug
I
on
don't
the
know if you
charts.
remember that. If you remember that trade, I think we looked at it last week.
Yeah, I remember you had a nice little matrix that showed where your cost was and where your break even
Oh
was
yeah,
and
yeah,
all
I do.
those kind of fun things.
I grabbed that chart.
The interesting thing about this stock is you could argue it sure has a long way to go if it ever gets its act together.
Hmm.
I did have another request for the Google Hangout, so bear with me here while I help this person out.
And this is
Uh,
this is a stock that it has nothing on its books. It's got like $40 million worth of assets, trading for like 300 times its book value already. It's absolutely crazy, but the thing is it might not even be done because
well,
of all the excitement with fuel cells and all the contracts it's hooked up. That people could run this stock for $20 even though it's worth $1, not even worth $1.
so if I remember correctly, your average cost on this trade after the option rate was about 6 and change, right?
660.
660. So
Yeah,
right there.
I have it up on my screen. Is it sharing?
Let's see. Do we have Joe's chart? There it is.
So this is the
We're right
market.
now. There, the market's testing your resolve, eh?
I'm right at my break even.
Yeah. Well, it should be an interesting experience for you.
Hmm.
I mean, I guess ideally you want it just the stock to be called away from you and you just walk away with a nice
Oh
little
yeah.
capital gain.
Anything over 8 would be great.
Yeah. All right.
But we had a rough last 3 days. It's what is it? The worst 3 days for indexes since 2011. So 3 days
Well,
in a row.
I have friends of mine that trade the ES, and they asked me just to, and I'll just throw in my 2 cents here. Um, This is the S&P depository receipts, and you can see that, yeah, we definitely have had a bit of tough slogging here. It was actually interesting, because we are doing options, that I did a detailed analysis of the weekly options expiry last Friday. And this is a very handy tool if you understand how options work. Hopefully you can see my screen right now. Yeah. So this is the S&P 500, the ETF, the SPY. And what's really interesting about this is that you can get a pretty good idea of where the market makers want to take the market out and what kind of money they're going to make if they do take the market out at certain levels. And what I noticed was, first and foremost, this 190 strike price, it had 190,000 calls written and only 7,000 puts. So basically, if they prevented the market from closing on Friday below, or prevented it closing above 190, then 190,000 calls that the market makers wrote will all expire worthless. So what's fascinating is Friday is options expiry, and you can see how the market opened up, it went into there, and then the big money, they just sat on the market, and they just drove this thing into the ground. Interesting here. The 189 strike, there were 43,000 calls and only 21,000 puts. So, if they basically had an average right price of the same, then that's a nice payday for them, right? They're liable for 21,000, of which they've written 40,000. So that means another 20,000 calls are basically free and clear for them. So that was a nice payday. As we get closer to where they actually took the market out, and now this gets really interesting. This strike, the 188 strike, basically was a wash. 24,000 calls, 27,000 puts, so not really that big of a deal to them. Now, this is the one that I was most interested. The 187 had 20,000 calls written, but 60,000 puts. And what's fascinating is that these options expire. They are marked to market at 11 a.m. Pacific time every Friday, exactly on the nose. And there really is no significance to that time frame other than the options, right? There's no markets that close. It's right in between business, so they can move the market further around after that event or prior to it. And what's fascinating is that at 11 a.m. they closed it at exactly 186.99. So literally, those puts expired 1 penny in the money. They were forcibly exercised, which means that the institutions had to buy a net 40,000 times 100, right? 40,000 calls times 100. That's 4 million shares basically at cost. So now keep in mind that they wrote these options, so that means that they collected a premium. If they collected the premium, then that means that their cost is actually lower than this nominal amount. So as a result, they had lots and lots of incentive just to turn around and just sell, right? I mean, you don't know what the average price is for that put, right? It might have been $2 or $3, of which if they sold right here on exercise, their cost might have been down in here, or maybe even down here, so they're sitting on fat profits. I thought it was interesting here, the next strike price down, the 186, there were only 11,000 calls and 37,000 puts. So in essence, that's 27,000 net clear options that as long as the market did not close below this level, that the market makers just pocketed whatever the premium was on that. So really fascinating how they took the market out at exactly the level that they wanted this to have the stock at, so that they could continue selling. It was very, very interesting action. And you're right, this past couple of days has been just an absolute drubbing on the S&P 500. It's been painful, but it's interesting to see
So
that
you
if
think
you
that the option expiration had a lot to do with that?
I believe that the institutions were very stock heavy coming out of that event,
Hmm.
and they don't want to be stock heavy, right?
Yeah.
So, but my hunch is that what they wanted was they wanted the stock at cost. So they close it at 186.99. It's a 187 put. So literally that option expires 1 penny in the money. So if somebody bought the option, let's say, at $1, right? Then
Hmm.
in essence, because it expired in the money, the exchanges can forcibly exercise that option. And so usually on these weekly options expiration, it's just a line item thing on a counting sheet. It's just ching on the 11-hour bell, boom, you just got a debit in your account, you just got a credit in your account.
Hmm.
So it happens that fast. Um, so they were stock heavy coming out of this event, and keep in mind that their cost for that stock, because they collected a premium, because it basically finished at the money, their cost was down below. So it was lower, so there was incentive for them to liquidate that position. Now, you might also argue that maybe they have a short bias anyway, right? Because I was making reference earlier when I talk to my trading buddies, and I look at they like to trade the ES, but I mean, where do you start drawing fibs off of? I mean, geez, it's relentless. The last major cycle low, every time I pull the chart out, there's a new lower low. Where do we go back to find? Oh, finally back here. Okay, so you know this is all about risk in the marketplace. You realistically have to be able to risk a move on the U.S. stock market, and these are getting to be some pretty big numbers. 158 right now is the 38.2, and what a coincidence! It just so happens to be right off of this low, right? For major support. So you probably heard me talk about the stock market's very seasonal. So we have a nice cliche that says "sell in May and walk away." And usually the stock market likes to top out right around my birthday, which is right there. So we're fast approaching that. There's been lots and lots of experiences in the market where the market tops out in late April. It doesn't have to top out in exactly May. But long and short of it here is this, in my opinion, is a very risky stock market. This is from one. Let's call it 190, right? What was the exact top? The top was 189.70, right? So 10% is basically like 19 points, right? So that would take us down to 169. So that's down in this area. That's a 10% correction, right? If we go down another, that's 169. So 158 is another 10 points. So literally, this, and the irony of it all is, like you could look back 5 years from now and not think anything of it, but this is literally a 15% risk window right here. That's just sitting there saying, I'm sitting here wide open. If I want to break, it's perfectly realistic for me to break down to the 38.2, which, I, as a commodities trader myself, I set my watch to that level. And then, I suppose if we do some fibs off of this level itself, because it looks like it's fairly important, 38.2 here is 176, which happens to be off that level. So, this is a pretty risky market, no doubt about it. And, just seeing, this 190,000 calls, I mean, the market makers, they're loving this. They're rich. I mean, that's a lot of money. If you figure that maybe just $1 a point, right? And that's average. Some people may pay 2, they might pay 5, it might pay 10, but let's just say the average writing price for these 190,000 calls was $1. Well,
Hmm.
so that's 190, 1.9 million. That's basically about $19 million, right?
Hmm.
If the price was 1, if the price was 10, well, that's $190 million. But it's probably like about 20 million bucks. So they got lots and lots of ammunition to drive this market down. So it doesn't surprise me to see this action at all.
Brian, you told me before that basically these monthly option expiry dates are like a free trade.
Pretty much.
Now, do you ever trade them?
Oh yeah, I trade every week.
Oh, you do? Okay.
Now, I don't necessarily
What do
trade
you?
the option itself.
Well, no. But
But what I'll do is I'll look at this, and to give you an idea,
do you
that was
trade?
the
You
that
trade
was the
stocks?
S&P 500. Here is the oil ETF, the USO. Right? So same logic. Can you see my screen?
Hmm.
Make sure that you can see my screen. Okay. So the SPY is our proxy for the broader U.S. stock market. USO is our proxy in the stock market for oil prices. And so we see, and this is exactly the same logic. 2,500 calls at 37 and only 200 puts. So there was a lot, even though, keep in mind, USO is trading above this level and at this level, right? So, I mean, it wasn't unrealistic for it to expire in the money. But there's no way with this kind of money sitting on the table that the market makers are going to let that slip through their fingers. They literally sit on things to make sure that they don't go out at certain strike prices. So in this example, there was 1,900 calls and 1,100 puts. I find it fascinating that basically they took the market route right at that level. So looks like they had a little bit of a net buy there, but because it closed at 36.50, and you'd really have to see exactly when this thing opened up the next bar. I don't know if they were exercised or not. This one looks like it was a wash, but look down here. This is the 35.5. 2,900 puts and only 350 calls. So again, just like this scenario, and the stock was trading below it, so it's not like it's totally out of the question. But the market makers had a huge incentive to make sure that this market did not go up below this 35.5. Do you follow me?
Hmm.
Right? So the trade setup, and it's a gift every single week, is to literally buy the market on the European close and look to sell it into the options expiry. So in this particular example, there's our options expiry at 11 o'clock. European close for us happens... and it really wasn't that good of a setup this past week, but the European close was right there, and we had a little bit of a rally. And, this setup in particular, the way the options trade works specifically is you ideally want to have the market being driven down early in the day, whereas we had an up market. But long and short of it here, and it really wasn't much of an example, but European close was right on this bar here, and my trade setup, it's the gift. Every Friday, European close, you buy the market, and you expect a rally above whatever any key strike prices are. Now, it turns out at this one, they took it out right at the strike price, which tells me in itself that they wanted this stock, whatever it was. And let's see what it did after. I don't know, did it move higher? No, look at that. It totally backed away. So, obviously we talked about how they were net buyers, 1,900 calls versus 1,100 puts. So they had 800 calls, which is 80,000 shares. And so you can now keep in mind that they wrote these calls, right? So they collected a bit of a premium. So, their cost might have been here or here or here or whatever. So they had incentive to bring the market down after that event. The treat is when you get, I just don't happen to have one on me. Maybe next week when they do the options expiry, we might see the setup. But the treat, and all I want to do is just get a nice a clean sheet of paper here for you guys. The treat is if you can find a situation where they're driving the market down into the European close, because for one reason or another they want to mark the market lower, and then right on the European close they'll literally rally the market right up into the options expiry. So this past week we had a fairly strong market into it, so we didn't really get the setup that I ideally like to trade off of that. Oh, geez, I keep doing the same mistake. That I ideally like to trade off of that that options expiry event, but nonetheless, it was perfectly valid this week. So it didn't really set up the trade event that I like to do, but the information the information itself was perfectly valid.
Okay.
All right. So I sort of got off on a tangent there. Sorry about that. But this weekly options expiry stuff is really powerful. And the thing is that these weekly expiries haven't been around that long. These weekly options have not been around that long.
Do you know how long?
So it's still a relatively new phenomenon in the marketplace.
Like last 5 years? Or?
Yeah, no, not even that. Maybe 3 or 4 years. No, well, I guess longer than that. Maybe about 5 years, somewhere in that neighborhood. So, in the life of the stock market, that's a week and a half, right? That's nothing. All right. So let's see how we're doing. We do have a couple people in the lounge. So welcome, Eric and Marcus. If you happen to have questions, we'll probably have a little question time at the end. These are typically an hour and a half to 2 hours long. We'll just try to keep it moving forward. So the question, I suppose, Joe, is should we just go through the format of the stuff that I sort of wanted to review, and then you just throw in questions and ideas along the way? Is that what we're thinking?
Yeah, for the commodities, yeah.
Okay. All right, so I guess we'll start off this with the Joe had an idea that he kind of wanted to look at commodities this week, and I think that's a pretty good idea to look at commodities every once in a while. I'm not overly bullish on any one particular sector, but there are a few commodities that we'll take a look at that look interesting. You can go and find, for anybody who's watching this show, either on YouTube or in the Google Hangouts, you can find a lot of my sort of commentary and stuff on my trading forum. That's off of this website, the rationalinvestor.ca, under the trading forum link. Every week, and Joe sort of caught me with my pants down, so I'm going to have to get my act together. But every week for years and years and years, I published a weekly commodity trend survey where I talked a little bit about what I thought was going on in the broader market. And then I follow specifically about 40 different commodities. I trade crude oil on a daily basis, and had a nice day in crude today, so I'm feeling pretty good about my trading there. Basically, I've been involved in the commodities business now for, the better part of 20 years. So feel free to pop in there. I often do a commodity spotlight. Like I said, I haven't done too much work on it, and I also do only doubles trades. If I happen to see a only doubles trade, that's basically a trade where I think that we can double our money with relatively low risk to our original capital. Then I'm interested, and it's interesting that Joe mentioned commodities this week because over the fall I did have an only doubles trade here on sugar, you're more than welcome to go to the website and read all about that. Long and short of it here is we did get our double on the option, so we're feeling pretty good about that. All right. So moving right along. The next thing that I'd just like to touch on, so we talked a little bit about the trading forum and my weekly commodities Spotlight, and yes, I fully understand that I haven't updated it in a bit, so I need to get off my butt and update that for you guys. What was I going to say? All right. So when it comes to options, I was an options broker. You probably shouldn't be able to see my password there. Sorry about that. And I actually wrote a options trading algorithm that basically outlines where situations where the market will actually pay you to take positions. And I absolutely love this algorithm because in essence it highlights areas that are trading at extreme discounts to the market, and here are just a few of the trades that we had on. We've talked at length about some of these other trades, and I find it interesting that not only do these trades represent interesting short put ideas, like I said earlier, where the market can pay you to take a position, but at the same time, you can also find some very interesting long call positions because, again, these stocks are trading at such huge discounts to value. You're more than welcome to go to the website. This is therationalinvestor.ca. WDB options. You can just basically go to CRI's algos and click on the WDB options model. It's still in beta, so which means that you can sign up and get these reports in your email for free. So as soon as we get some traction there, I'll probably turn it into a subscription service, but for now it's still free. So I'd highly encourage you to take advantage of that. And the reports that are generated are just absolutely beautiful. I mean, in the daily basis, I get a nice little summary of the positions that I'm holding in the account, all the WDB ratios, as well as new stocks that pop up on the screen. So to that end, Joe had suggested that he was kind of interested in the gold and silver sector right now, and I looked at the charts just quickly. I'm still a little bit leery about whether we actually have a bottom in the gold and silver market yet, and I found it interesting that when we did get the bottom in the gold and silver recently, like last year, let's see, do I have that? Just the silver, last summer we had an interesting bottom. I got a lot of WDB candidates that popped up on the screen when we were tanking through this mess. I'm not getting those WDB ratio screeners. So that tells me, this is silver in particular. I actually, when I look at this, it looks to me like the market's a bit complacent right now. So ideally, when I'm buying options, I want to buy, a nice strong trending market if I'm going to go long, or if I'm going to write the puts, then I really want to see some fear and I want to see some blood in the streets. And ironically enough, that's also a good time to think about going long too. So to that end, I thought I'd just take a moment and review a couple plays recently that have done very well for us. The first one, and you heard me talk about it last week, is this Gafisia. Basically just keeps charging higher, up another 6 cents on the day. You can see all the Brazilian plays are all very, very happy. The Brazilian ETF itself just keeps rocking higher. You can see nice double bottom there. Look at the nice double bottom in Willie here. So we're definitely in the midst of a nice rally. The PBR being one of the biggest companies in the EWZ, not a big surprise that EWZ is moving up if PBR is. He keeps moving up to new highs now, 14. Excuse me. Excuse me. Good boy. All right, 14.22, up another 91 cents on the day. I mean, it's just stunning to watch these things in action. Basically, we spent lots of time looking at both the long calls and the short puts on these guys, and they look very attractive on a longer-term basis. Of course, keep in mind, PBR himself was up here at 70 bucks, and the last peak was 52. So could we get a rally back to 20? I think that's perfectly realistic. The write-up, you'll remember from last week's show, basically this was an $18 strike. $7.20 was the premium suggested to collect, which brings your cost on the stock to $10.80. So there's that floor at 10.80. I mean, even from 10.80 now at 14.22, we're starting to talk about like a 40-50% return on your money. At some point, regardless of our long-term views of this company, these returns are starting to get a little ridiculous. So, long and short of it there, I think the Brazilian story is still fully on. Really, I don't see any reason for that to change as we head towards the World Cup this summer. And our two little stock proxies in that arena are just performing really, really well. And I see no reason whatsoever to step in front of these things. In fact, 349 was the high, 344 was the high. So today's high, 345. We're just threatening here to break out, and you can see the trend line resistance. That's a good 50 cents dollar higher. We might actually see this thing go parabolic here pretty soon. So that's really exciting. All right, so we talked a little bit about the WDB. We've talked a little bit about the weekly commodities trend survey. We'll get on a little bit more on that in a second. See, is there anything else I need to talk about? We talked about a couple trades that are on the book. Some interesting new trade ideas. Again, the screen right now seems to really like European financial stocks. So AEG is Aegon. It's an insurance company out of the Netherlands, and RBS Royal Bank of Scotland. We do have one gold stock that is actually coming up on the screen. So maybe I was a little bit premature to say that I'm not seeing any, because we do have one. And actually, this is an interesting story. They have no debt at all, trading at 0.78 times book and only 2 times cash. So they got a whole bunch of cash on the books. I'm not overly excited about buying this. To me, this looks like we need to probably test these lows again. It'll be interesting to see if, number one, we can get some more gold stocks popping up on the screen. I looked at something like Newmont Mining earlier, and I'm just a bit concerned. The gold price itself has been moving up, but these gold stocks have been backing off. So there's Newmont backing off. I'm a Canadian, so the biggest Canadian gold stock we follow is American Barrick. In fact, it used to be called American Barrick, the symbol ABX. Now they just call it Barrick. But anyway, double top up here. Barrick is notorious for hedging their portfolios. So obviously this double top here means something to the market. When I look at price to book, 1.5-ish, price to cash, almost 9 times cash. Nothing really compelling jumps out at me there yet. So I think the best thing to do in the gold sector is just to be nice and patient and relax. The opportunities will come. I just don't think they're here just yet. Joe and I, before the show, were taking a quick look at the commodity sector. That's sort of why I brought up this trading forum. And one market actually that jumped out at me that's been doing quite well lately has been the coffee market. And what's really fascinating here is you see back on January 31st, we actually had a long signal. According to the weekly commodity trend survey, you should have bought at 122.75 with your stop at 113 and your target 172.50. That's a horrendous number. So let's go see how coffee did over that intervening period. All right, so that's a weekly commodity trend survey, so we always look at the weekly charts. And if we zoom in, Let's see where we are here. All right, so the double bottom came in January right here, eh? So that was the buy signal right here. Geez, you think I should do this weekly commodity trend survey more often, eh? Look at that. And your stop was right there, and look what happened. Vroom! That's crazy. And so the target we said was 172. Look at that, eh? Son of a gun. So how did we figure out the target? All we simply did was, and it's fascinating actually that you brought this to my attention. It just goes to show, Joe, I shouldn't have been negligent here on this the past few weeks. But anyway, what we basically do is we say technical targets. Whoops, is what we call. I always use the 50% rule when I'm coming up with simple targets. So 50%. This is this. Where's 240? Okay, so 240. That would be off of this high here, down to this low here. $345. All right, well, it comes out with a 50%, and I'm just using these numbers. Keep in mind that this is, if I look at the charts that I use are specifically these, and I guess that would have been that high off of there, so you can't see it on this chart. 240, that would be these peaks right here, so there and there. So yeah, that's basically where I'm, maybe up here. But so anyway, here's the 50% rule right in here. The interesting thing, of course, is that we've shot way beyond it, and I suppose you could argue, I love the 50% level as nice simple targets, but you guys, if you're regular listeners, you've also heard me talk about the optimal trade entry, or what we call the OTE. And in this case, it's the short zone. And that just so happens to be exactly where we stalled here. So, looks like that was one hell of a call. Way to go, Weekly Commodity Trend Survey. Man, that's incredible. It was a hugely profitable venture. Do you believe that there's more to come? I'd hate to say it, but I think the trade's probably done now. And then on sort of a final note to this, I thought we'd take a look at one company in particular that, of course, everybody knows about, Starbucks. And so for those people out there watching this video and saying, yeah, well, I love commodities and all, but I can't really play commodities because I don't have a commodity account, or I don't have a commodity option account, whatever. This chart that you see on the screen right now is an overlay of coffee prices and Starbucks. And I found it fascinating that you could literally see a bottom in coffee prices was coming in at exactly the same time that Starbucks stock itself topped out. And sure enough, keep in mind that Starbucks, they're basically in the business of selling coffee, and they sell a lot of coffee. And so as coffee prices were crashing here, their profit margins were getting wider and wider and wider. Sure enough, once coffee prices did turn, that euphoric premium bid into Starbucks' stock has been slowly eroded away. I thought it was interesting, Joe, you had that Green Mountain Coffee Company, which I think might be more of a supplier, and we found that it actually seems to be moving with coffee prices as opposed to against it. So what was that symbol again for Green Mountain Coffee? Am I just talking to myself? Joe, you with me, buddy? All right. He said, be right back. I would short Starbucks. I don't like their coffee. Well, aside from our feelings about Starbucks, how do you spell Green Mountain? There are a lot of people that have made a heck of a lot of money off of the stock itself. I thought it was called Green Mountain Coffee Company. I may be mistaken. Green, what do we got here? I don't see it. Anyway, so when Joe comes back, we could probably talk to him a little bit about that. But long and short of it here is, for those people out in the world who, saw this Starbucks chart and said, well, the company's perfectly fine. And then you listen to me, Mr. Technician, and I say, well, the OTE sweet spot's 61, and here we are up at 80. How's the price going to get down to that 61? Well, the company's doing fine. People are buying the products. And yet this is an excellent anecdote of risk in the marketplace. You just never know where risks are going to come from. And in this case, it was actually the risk of the underlying product that they sell into the marketplace appreciating in price and cutting into their bottom line. All right, moving right along. Thought I'd take a moment, sort of continuing the commodity theme, and take a look at cotton prices. I don't know whether any of you out there in internet land or in our group here trade cotton, but cotton is very susceptible to crop damage. And of course, if farmers have the choice, they can either plant cotton, soybeans, or corn, and even wheat in some cases. But typically the choice is, do I plant cotton or do I plant corn? And so you saw this big run-up where basically cotton prices exploded a few years ago due to a blight and also the fact that corn prices were high and a lot of farmers were choosing to plant corn over cotton. Put it all together, the blight fears dissipated, and then also we've had maybe a bit of a resurgence of Chinese economy, so textile manufacturing is starting to get going in earnest again. Demand's coming back into the marketplace, and we have a very interesting base that's trying to form here on cotton prices. Now, this high, is 220. Am I saying that we're going to go back to that high? I doubt it, but we might. What I'm just looking at this from is just a purely technical bounce off of these 220 highs. And, we just saw how it worked in coffee prices. If we take a look at cotton prices using the same logic, the high 225 down to the low 66, 66.10, yeah, that's pretty close. 50% level is 145. So, even from the 80, 90 cents a pound right now, or a bushel, we're still talking about the potential of prices almost doubling from current levels. My OTE, or the optimal trade entry, would actually suggest that cotton prices could realistically hit $1.78 or 178 cents. I think it's a pound. Can't remember offhand. So, if we start to look at some of the numbers, they start to get very interesting from an options perspective. I can go out into the marketplace right now, and I can shop the options marketplace going all the way out to December 2016. So that's basically about 2.5 years away. If I even just look at December 2014, which is what? April, May, June, July, August, September, October, November, December. So that's 9 months of time. The numbers start to get very interesting. So I'm going to pull up that December 2014 contract. You see it's trading at about 80 cents. And I'm going to take a look at the calls. And what I see is that at the money options, like we said, trading at about 80 cents, they're about $4 or $5, and they got lots and lots of time. In essence, this is $5 a point, so this contract is basically about $2,500, right? Somewhere in that neighborhood. If I zoom out and I look at, say, the 90 or 95 or 100 calls, then they start to make some interesting numbers. So on our chart in particular here, we took a look at the 95 call for December, and right now it's trading at 105 points. Keep in mind that it's $5 a point, so basically that option is going to cost you about $500. And in essence, for the next 9 months, you basically control 50,000 pounds of cotton from this 95-cent level. As you can see, just our 38.2 fib, right, and this is what I call my first stop target, it's sitting at 127. So if we just figure what's the intrinsic value of this option, no time value, no volatility premium, no interest rate premium, just intrinsic value alone, if sometime over the next 9 months we get up to this 38.2, this option will have 3,200 points of intrinsic value. Keep in mind that we're spending 105 points right now. Or, times $5 a point, this option will have an intrinsic value of $15,000. So $500 to a potential of $15,000. That is very attractive. Now, if we happen to get a rally back to the OTE sweet spot, and I'm not saying I want to see new highs, and frankly, this might be a bit unrealistic considering the time, but the commodities, they're volatile by nature. If we get to the OTE sweet spot, this option will have 8,200 points of intrinsic value. At $5 a point, that's $40,000 for that one option that we bought for $550. To me, that's a very attractive proposition. It's the kind of thing where, if you're dealing with $10,000, $20,000, maybe go buy one of these. $500 on a cotton play. Don't risk more than 5% of your portfolio, and just see where it takes you. I would argue that this is not a bad risk reward, and I would argue that it sort of meets our sort of 10-bagger potential trade setup that Joe and I like to focus on through this option show. All right, let's see if my buddy's back. Joe, are you back? Well, still gone. All right, well, maybe I'll do the rest of the show without him. All right, it's 6 o'clock now, so moving right along. So I'm just going to save this, and we'll just put this as a cotton options. All right, and then we can put you away, and we looked at Starbucks, so we can put him away. We looked at PBR, so you can put him away. We looked at Gaffy, yeah, so you can put him away. Cotton options, we looked at that. We can put that away. All right, so and the coffee, I might want to do a write-up on this later, so I'll put you over here. Okay.
Sorry to interrupt, Brian, but I found that Green Mountain Coffee Company, if you're still interested. It's GMCR.
GMCR. All right. Well, just to finish that thought, where was our coffee? Here's our coffee. Oh, I got rid of Starbucks. Well, you know what I want to see is how do we do this? Let's go like this. GMCR. And thank you very much, whoever that was that chimed in there. Okay, so this is our. How does this work here? This is our coffee prices. Can I move this up? Oh, they're locked. Let's put left. All right. I don't know whether this moves totally with coffee prices, but it is interesting to see here. As coffee prices were moving up, so was the stock price. As coffee prices topped out, down she came. Interesting to see that the stock herself, she actually turned here and started moving higher, even though prices for the commodity itself were lower. Nice divergence here, lower lows, higher lows. Then we've had this rally and the stocks moved to new highs. Don't see a heck of a lot of correlation here. I think the story really, if you're going to follow coffee in earnest, is this Starbucks because they're such a big player. First off, I guess that was that Marcus that helped me there?
Yep, that was me.
Thank you very much, Marcus.
Yeah, I remember reading about that company. They're into all kinds of like soft drink stuff, and then they had a big deal with Coca-Cola. That's what made that big spike there. So
Okay.
they're not
Yeah.
they're
So
not that close.
kind of apples and oranges.
Yeah.
All right. But anyway, good to know. All right. So I think I'm going to finish off today with just a little tutorial on how the gold market works. Actually, somebody's figured it out. Huh, good luck. But what I'm going to finish off with through this presentation is Joe had come to me and said, you know, Brian, I'm really interested in the gold market, and I think gold is bottomed, and I'd like to do the show on gold and silver stocks. So, you know, the first thing that I do whenever anybody comes to me and says, all right, I want to talk commodities, I want to always go to my weekly commodity trend service. And like I said, I've been a little bit negligent here. I haven't updated it in a bit. Probably ought to get off my butt there. But long and short of it here, as of the end of January, beginning of February, gold was in a down market. With short level stops. The target was actually hit. So this gold trade itself is getting a bit old. But in essence, these levels here are just simply off of the principle that lower highs and lower lows defines a bear market, and higher lows and higher highs defines a bull market. So Joe asked me just to pull up the chart, so I pulled up the chart. And what I see here when I just look at gold is I see lower highs and lower lows. So I certainly cannot be bullish of gold right at the moment. And what I tried to explain to Joe when I was talking to him earlier is that maybe at best we could argue that the gold market is sideways. But I certainly don't think that we're in a bull market in gold just for the time being. All right. So whenever you're considering playing the gold market, this is a very handy tool. And I've used this for years and years and years. This is a chart of the gold, the XAU USD on the trading view. And I've overlaid the chart of, in this case, American Barrick. And the reason why I like American Barrick is because it's sort of the Canadian gold proxy. It's our biggest gold stock here in Canada. And I'm just trying to get these silly charts to line up here for you, so that you can see this nice and clearly. Oh, it's very frustrating working with TradingView in this regard. But anyway. Okay, so, there's a simple question as investors that we should always be asking ourselves, because remember, we always want to be following the smart money. I follow the Commitments of Traders reports, and when I was doing my my weekly blog on crude oil, every single week I would comment on the Commitments of Traders reports. This is very, very valuable information, and basically we as small participants, we can't move the market. And anybody who tells you that small retail players do move the market is full of horse hockey. The long and short of all that is the only people that really can move the market are institutions, and then specifically the companies that are actually involved in the business itself are often the absolute best proxy for the direction of the commodity. So whenever you're looking at or considering buying gold, for example, and this upper chart is our gold chart, I always suggest it's a good idea to take a look at the gold stocks themselves. And quite often you will get divergences. And so that's sort of the purpose of this little tutorial here. Is I just wanted to highlight how using divergences in the gold stocks themselves can often highlight a future price action. So Joe and I looked at the gold chart, and this low here, disregard the bearic chart just for the time being, this low here was actually lower than this low here. So technically, according to my commodity trend survey report, gold is still trending lower. And like I said, this low here is 1182. It was lower than this low here, 1183.20. So people will say, oh yeah, but it was just by a couple ticks. Well, I don't really care. The point of the matter is we're making lower highs and lower lows. Until that stops and we start making higher highs and higher lows, this market is still pointing down for me. So when I look at the gold, at the very, very best, I can say, okay, well, maybe we're in a trading range. Okay? So if you're in a trading range, then ideally you want to look at all the sort of little underlying indicators to see whether they are suggesting we move higher or lower. So as we approach this low here, and yes, we did make a new low, it was interesting at the very same time the gold stocks themselves, and Barrick here as an example, it was not making new lows. So this is an example of a bullish industry divergence to the commodity price. Keep in mind the stocks always lead the commodity. Who better to know what the future of the underlying business than the people who are actually in the business, right? Just makes common sense. So bullish divergence here suggested that we ought to think about buying down at the bottom end of this range. Well, now on this most latest rally, you can see, and this actually has me a bit disturbed for the bulls, that we had a bearish divergence in the gold stock itself versus the commodity price itself. So whenever you see this, basically it's saying that the people that know the business and that are in the business, American Barrick in particular here, they're pushing their stock price down. That's not bullish, that's bearish. Sure enough, at some point, the price of the commodity had to play catch up. And that's basically what we're going through right now. If maybe we could take Barrick off, and let's look at the basket of oil stocks or gold stocks. Let's see if that's any different. That's XAU. Let's see what we get here. Where is it? Dun, dun, dun. There it is, way down there. And keep in mind, these are sometimes tough to work with, so we just got to bear with us. All right, that looks a little better. Okay, so same thing as Barrick, eh? Look at that similarity. Remarkable. So you make the argument here that we had a bullish divergence here. Oh God, this is so frustrating to work with. Right? Not nearly as clean as Barrick. In fact, not even really much. Littlest of divergences there. But what I do see is, oh, and that it's interesting there. So these gold stocks themselves, the entire basket, is not too divergent. Now it's interesting to see how we went parabolic here, but not so much of a parabolic move there. And actually, this looks like it's following fairly cleanly here. Here's probably a good example. Just and keep in mind this is gold and silver. A little bit of a difference, but we had a higher low there, but in the gold and silver, we actually made a lower low. So, bit of a problem here. Sure enough, down we needed to go. Be interesting to see what Newmont looks like, but maybe we'll leave that for another day when Joe comes back. Now, interesting on the gold and silver, so I think I'll just keep my Barrick. I like that Barrick. Where were we here? I like that Barrick. That was a really nice comparison. And it might also be due to the fact that Barrick does hedge their portfolio, so that may have a bearing. All right, now where did my Barrick go? Where are you, Barrick? Let's see where Barrick went. Oh, it says loading. All right. And we also have to keep in mind too that internet connection's been a little bit splotchy, so I have cut out a couple times. Joe, are you here back? Are you back yet? So he's still not with us. All right. Well, we'll have to leave that for now. Looking at the other metal, I thought I'd just touch on what are my thoughts on silver right now. And it's funny because when you're looking at silver, I almost wanted to make the same, a similar argument to this silly Bitcoin, in that we're just riding these downward pointing channels. Some people are, saying, well, we got a double bottom working here, and this might be off of another bigger bottom. And money flow looks like it's relatively okay. So I am watching silver quite closely, and kind of similar to that cotton, not nearly as clean or good looking a chart. But when this thing does turn around, you can see there's lots and lots of money to be made on the upside. So we'll be keeping a close eye on silver over the next few weeks. I will feel very confident that we're near a bottom when I start to see some gold and silver stocks come up on the WDB model in earnest. So we'll see how that goes. Oh, there's Barrick. Okay, so I got to change the scale. Boosh. And then we'll move there. All right, and so that was that divergence there. To there. That was there to there. Okay, so it is now 6:15, so we've been going for about an hour and change. I think at this point, if my partner is having a hard time staying connected or is predisposed with something else, I think what I'll just do for the time being is leave the floor open to questions for a couple minutes. I think of value this week, I think that the cotton trade is something that I'm very interested. So that's something that you can take away from this show. That's probably a new idea, if the web page wants to load here, that is. I suppose that's the one problem with doing these. Where are we here? Doing these shows using this trading view is that we are completely beholden to how trading view is acting right now. All right, so put it back on the main page. As soon as that cotton trade shows up, I'll show that on the screen again. So there's one trade idea of Ernest that I think you could take some value in. I will work on updating the commodities board. I think we're a little bit early on the gold and silver. We do have a seasonal window coming up here, which explains stock market action. We took a good look at the weekly options expiry issues and how they affect the market. And then we finished with just a quick look at the concept of stock divergence and how the stocks of an underlying commodity will often be a very good indication as to the future direction of the commodity itself. So with all that said, I think basically that's the end of my presentation at the time being. If Joe is here, you're more than welcome to do a little presentation on your own. Or if any of our panelists have any questions, feel free to chime in. I see we have 4 or 5 people here. So I will leave the floor open for questions, and I will go on mute. It is now 6:16, and I've been talking for about an hour. So fire away if you have questions. So I need some elevator music right now. Anybody knows how to pipe in some elevator music on this thing?
I can sing you a tune, but you'd probably wouldn't sound too good. But no, I like that cotton setup there. I've been following the commodities for a while too. Actually, I bought some corn a couple weeks ago, but I just bought the underlying ETF. Still fairly new to options, so I'm not really feeling confident in them yet. That's what my question is about. I've heard in general it's good to buy just in the money calls in this case if we're expecting cotton to go up. So just in the money calls with like a 6-month expiry. Can you talk a bit about like how your selection process would go on if you were to take this cotton play? Like what option would you actually buy?
Yeah. So do you mind if I ask who told you that strategy?
It was a YouTube guy, former Bear Stearns floor trader, big options play kind of guy. He swing trades stocks and general equity markets.
All right, so because the problem that I have with that strategy is that, in my opinion, actually, that's about the absolute worst option purchase you can do. And no offense to you, okay?
Right.
Don't take it personal. But you have to understand how options work, right? Options have a whole bunch of ingredients. Have you ever heard of the term black skulls?
Yes, I have.
Right. So they have a volatility premium. They have a time premium. They have an interest rate premium, and they have intrinsic value, right? An option that is just at the money, right? It's just in the money. Ironically enough, it will actually go up by a lesser degree than if you just own the actual commodity itself. So you may get like a dollar rally in cotton prices, and yet your option only moves up 50 cents. And you're like, what the heck? This doesn't make any sense. And trust me, I know this from personal experience. Now, if we look at option prices, right, we'll look at the cotton, for example. And, please don't take any offense from this, all right? Because, I had to go through the same learning curve, too. And let's just, we'll look at the summer contract here, the calls. And the underlying right now is 91.28. So that's right here. Okay. $3.91. If you with me?
I am, yeah. That's the closing price today, you mean?
Of this particular option, the 91 call, and the future itself is at 91.28.
Right, okay.
So the question I have for you is, we know that the underlying is 91.28 and the option is $3.91. Okay? What is the intrinsic value of that option?
It's the difference between the price of the underlying and the price of the option, isn't it?
Yep.
Yeah.
91.28 is the price of our commodity, and it's a 91 call. So what's the intrinsic value? It's basically like, what, 20, 30 cents? Right?
Couple cents, yeah.
So that means that there's something else going into making up this $3.91. Right? Does that make sense?
Yeah, the time factor likely, isn't it?
Well, what it primarily is it's the fact that it's at the money. So, and what I really need for these demonstrations, actually, it's kind of good that it's like this, is that what happens is, and I'm just going to draw this here, so bear with me, my crappy writing. Can I draw this? Maybe it won't let me. Oh, shuckaroonies. Well, we'll have to, let's see if I can find a blank part of this. Okay, so forget about the silver. Don't worry about that, okay? An option will actually, whoops, what the heck's that? Let's try this again. Boink. An option's rate of change will actually go like this.
Oh, I have seen those curves before. I was wondering what they were. Yeah.
Right? So, where your strike, this will be time, right? Like that. And this will be your strike price. Say there. Okay? Maybe there. So for this example, we're just talking about, we'll say 91, right? Is right there. And the greatest rate of change for the actual option is where the underlying commodity, right? This is the, and here, let's just put up here, this is the 91 strike, right? Because this is just this option alone, right? Nothing else, just this option. And we'll put a nice box around it, right? So it's just this option. That's all we're looking at, right? Okay, so the price here, right, is say like, I don't know, we'll say 80. Okay? And the price up here, we'll say is 100.
Okay.
All right. Hopefully you can follow me here.
Yeah, it's just the y-axis is the price.
Of the underlying.
Yeah.
of the underlying commodity.
Yeah.
Right? And we have a 91 strike, so that means our option is at the money right here.
Mm-hmm.
That make sense?
Yes.
All right, now what ends up happening in options land, right, is when the option is deeply out of the money, right, long way away from the strike price, there isn't a lot of volatility or time premium associated with the option. Well, time premium, yes. Volatility premium, no. Let's get rid of this. We don't need that. As the commodity itself approaches the strike price of the option's price itself goes parabolic.
So that's the sweet spot.
Right. To the point where this is, in essence, these options at the money should be about the same as the margin requirement to buy the futures. Does that make sense?
Because the price of the underlying and the option are so similar.
Yeah, I mean, if the option price was less than the futures price, then people would just go buy the option, right?
Sure.
Right, versus taking on the futures risk. So what actually ends up happening is that the option price is actually inflated as we get into here. So as we get closer and closer to the strike price, it literally can go straight up. But then ironically enough, this is as good as it gets from rate of change perspective. Now, once the option is actually in the money, right, it's got all that time value and volatility premium all built into it, right? Remember our cotton option right now, right? The 91 call has a grand total of 27 cents of intrinsic value, and yet the damn thing's trading at $3.91. Right? So what ends up happening is over time, the commodity may just keep moving up, but our silly option, the rate of change, it slows down. Because if you look at deep in the money option, so, we said 91 call, right? Let's look at an 80 call. The 80 call right at the moment is worth $11.56, of which, $9 of that is just intrinsic value. So that means there's only $2 of time value and volatility premium in that call. Does that make sense?
Yeah, it does. It does. But they are safer in a way, right? They have.
Well, so the way to play options, right? The way to play options and make money is to try and capture this. And this is what's called delta. Have you ever heard that term before? Delta?
Yes, I have. Yeah.
Right? This is the sweet spot of the options trade. And ironically enough, once you actually get to intrinsic value, the attractiveness of the option itself actually is less attractive than owning the futures contract itself. This is the sweet spot. This is where the rate of change of the option price can be explosive. Does that make sense?
It does, yeah. And this is same for all asset classes, right?
Everything. Every option works exactly the same way.
Yeah.
So your gentleman who says buy the slightly in the money options is actually not doing you any favors, right? Because these options, they've got a lot of time and volatility premium built into them. Now, what happens, heaven forbid, what happens if the price of the underlying doesn't keep going up, but actually starts to go back down? Well, same thing applies. The rate of change is exponential on the way down as we move away from the strike price. So by you buying this option right here, you're paying the absolute most for the delta, right? And yet the irony of it all is if the trade works, you're actually going to make less money on a one-for-one basis. Like this curve is too steep. This curve should really, be like this, where it just drives you nuts. Right? And yet the commodity keeps moving up, but the damn option doesn't move. Right? Think of it this way, right? What price does this cotton have to be for us at expiry, for us, and it was the 91 call, what price does this have to be at expiry? If you bought it at $3.91 today, what price does the commodity have to be at expiry for you to break even?
How much time? What's our time?
At expiry. The option is expiring today.
Oh, okay.
What does the underlying have to be for you to break even on this trade?
91?
No.
Oh, I'm confused now. Yeah.
All right, so remember, these are insurance policies, right?
Mm-hmm.
So there is no intrinsic value to it right now, or at the time, right now there's 26 cents of intrinsic value, right? So you just paid $3.91 for this option. Boom! It's expiring today. What does the underlying have to be for you to break even? It has to be the strike price plus the premium you paid. So for you to break even at expiry on buying this option, the price of the underlying has to be close to 95.
Okay.
Does that make sense?
Yeah.
So it's actually a very tough game buying at the money options, right? Because you're paying a whole bunch of time and volatility premium, and you're saying, I don't even break even unless the actual commodity itself goes out at 95 bucks. So you're kind of handcuffing yourself a little bit.
Yeah.
Does that make sense?
It does, yeah.
Okay, so now, is there a different way of playing the market? I would argue if you're going to spend that money, that's a chunk of dough, right? That's $5 a point, right? So that's the better part of 20 grand, right?
Yeah.
A lot of money. I would argue that you would be better off to go, again, shop the out of the money options and look for deltas, right? Where, keep in mind, the delta is literally all the delta does is it says for every 1 penny increment move in the underlying, how much does how much does the option move, right? And this probably isn't the best drawing. I could probably do a much better drawing for you. Sorry. Let's see if I can find a site that actually has deltas. Well, anyway, we can maybe look at that next show.
Yeah, no, I'm getting enough here. I know where to look now. I've seen these before, so.
All right, so you understand where I'm going. So the bottom line here is I would much rather you look at an out of the money option, right? Just using this one in particular, and I'm not saying this is the best trade, 91, I would rather you look at maybe like $100 call, right? That's trading a third or even a quarter of the at the money price, right? And buy 3 of them. And then that way, if the delta on this option in particular is 0.3 at this point in time, then the 3 options together, which would be the same amount of money spent originally, right?
Mm-hmm.
The 3 options together will give you that 1-to-1 ratio. So the commodity moves up 1, your deltas have a delta of 0.3, so 3 times 0.3 is 0.9, close enough to 1, so it's 1-to-1. So in essence, you're playing the same market with the same amount of money, but you're using the deltas to your advantage. So now, if the market does run up, and let's say it just runs up to 100, like this thing here. Well, each of these three options will go to that 391. You know, we're just saying it goes to at the money, right? And now, you know, if this was delta 1 to 1, which it isn't, but if it was, and let's say the market just keeps chugging along, you now have three options that are 1 to 1, versus if you had just bought the one, you'd just be sitting there in the one option. If you're at this 100, you spent the same amount of money, you bought three of them, and if it is a bull market and it keeps chugging along, now you've got three options that are now making you, once we hit that 1 to 1 level, they're now making you $3 for $1 increment move in the underlying. Does that make sense?
It does, yeah. So I see the upside here, but what is why is it that out of the money options are, a lot of them expire worthless? I've heard statistics, really like low numbers, people actually make money with them. Is it because,
well, you know, now that's a bit of a misnomer, right? So think of it this way. You know, the futures here is 91, right? Look how many options there are. There are gazillions of them, right? And this is just the calls. There's the puts as well, right?
Yeah.
So by definition, just by pure definition alone, a lot of these options are going to expire worthless, right? I mean, they have to.
Gotcha.
So, you know, that's a cute way for the media to quickly discount the derivatives market and say, oh, it's just bullshit, don't get sucked into it. You know? Having said that, if you actually look at the specifics of what you're saying when a lot of options expire worthless, well, they do, because there's insurance contracts written on every single one of these strikes. So, you know, at least half of all of these options are going to expire worthless just by definition. They have no choice, right?
It's just not market participation?
Well, no. Keep in mind that there's market makers that have to make markets in these options, right? They have no choice. They have to, right? So, you know, it's kind of like you going to your car insurance, right? And you know, I live in BC where we actually have government-run insurance, and the government has no choice. They have to write you an insurance policy, right? So same thing here. There's a market maker for this number 2 cotton, and his job is to write the insurance policies for the cotton market. So he has no choice. He has to. He's contractually obligated. You know, are there a lot of people buying the $50 call that's $41 right now? Probably not, right? But he has to do that business. He has no choice.
Yeah.
So,
what do you recommend for a book or something to read on options? What was your introductory material that you
The School of Hard Knocks. I learned. Keep in mind, I was an options broker for a number of years, so I've had to do all the industry courses and stuff and all that, licensing. One person that his name is Macmillan. He's sort of like he wrote the Bible on option strategies a few years ago.
Okay.
So I look into that. You know, anything on the Black Scholes. Problem with options, though, is that I have personally found that the literature sort of baffles you with all the bullshit, and they don't actually leave the real good stuff, like the real stuff that's powerful, like that concept of the delta. That's very hard to find right up on that. Very, very hard. But one gentleman that I worked with years and years and years ago, his name's Ken Roberts, out of, I think he's out of Oregon now, maybe Northern California. He had this thing called the Silver Profits Insurance Plan. And basically that was using the concept of the delta to go and buy really long-dated options, where if you bought a basket of the options, if you added all the deltas together, they would come to a 1-to-1 ratio with the underlying. So, at that point, silver was trading 3, 4, 5 cents an ounce. You could go buy like a 5-year option play, like a $10 strike or something, which was forever out of the money. And you could buy like 20 of them, and they all had a delta of like 5%. And you could buy them for like 10 cents a piece. You go spend a couple bucks, but when silver got to $10, you had like 20 calls on the books. For the same amount of money as if you just went and bought one at the money call option when it was $3, $4. So, use those deltas when you absolutely are certain of a big bull market or a big bear market, right? You don't do those kind of strategies when it's iffy, right? I mean, and that silver profits insurance plan I talked about, it was specifically designed to target commodity markets where the market itself was trading below the industry cost of production. And that's the key. So if you can find situations like the coffee, for example, where we got down to prices where actually it costs more money to actually produce the commodity than what the current market price is, that's when those deltas really kick ass.
Mm-hmm. Okay, good stuff. No, that's good info. Thanks a lot. I gotta be somewhere top of the hour, so I gotta make a quick
Okay.
call. But
So
thanks.
I helped you there?
Yeah, absolutely.
Good. Well, then my mission is a success.
I'll be looking for that. I already found it here. I did a quick Google search. Lawrence McMillan, options
Yeah,
here.
that's right.
Yeah.
Yep. Have fun. I mean, if you really want to learn options from the pros, he's a very good start.
Good stuff. All right, I'll talk to you
All
later.
right. Cheers.
Bye.
All right. Do we have anybody else with us? Landon, are you here? Eric, are you here? And is Joe here? All right. Everybody's checked out on me. Okay, well, to that end, it's about 6:45 now, so the show's run about an hour and a half. I hope you've enjoyed the information that was presented today. Joe and I do these option shows every Monday afternoon, evening, and you're more than welcome to come on in. If you did find some value in the material that's been presented, I'd kindly ask you to visit my website and take a good look at some of the different tools that are available to you. Most of it's free. If you did like the information that was presented and you'd like to maybe give me a tip, tips are always appreciated. I have one of these Bitcoin tipping algorithms on my website here. Just click on the donate button and away you go. You can find me on Twitter at CRInvestor. I produce all of these shows and tutorials on a daily basis for your benefit. You can go to the Google Calendar, which will show you when the next show is coming up and the subject matter. Again, I hope you've enjoyed the presentation and you've taken some good value out of the material covered. And if you have any questions about how you can take the next step in your investing or trading curve, feel free to pop into one of my tutorials and ask me in person. I'm more than happy to help. Other than that, I think we'll wind this show up with a fond farewell. Eric is here, but he doesn't have any questions. So good to see that we're all tickety-boo, and I think we will call it an evening. So thank you very much for stopping in and watching the show, and we look forward to seeing you again on our next broadcast. All the best. Bye now.